Good morning, everybody. Thank you for joining us today as we talk about Social Security. I'm Betsy Reeves. I'm the marketing coordinator here at Elevate Wealth Advisory. And for those of you who are new to us, we are a wealth advising firm in Athens, Georgia. We've been here 30 years on September 1st. We were founded as Vickery Financial Services in 1982. And I'm pleased to introduce you today to David Jenkins, one of our wealth advisors. David's been with our firm since 2015. He's a proud graduate of the Terry College of Business at University of Georgia. And David just landed the title of Best Wealth Advisor in Athens, Georgia for the third year in a row. So he is a wonderful advisor. He's got more advice than just Social Security, but today that is his focus. And I will let David take it away. But first, just wanted to let you all know that down at the bottom of your screen, you will see a chat box as well as a Q&A section. So if you have questions for David along the way, just go ahead and write those down in the chat box. And at the very end of the webinar, we will get to all of your questions. Thanks so much. Welcome, David.
Good morning, everybody. Thanks for joining us. Social Security is always a hot topic. We just got done finishing a retirement planning class about it. And as usual, Social Security was the topic that got the most questions. So I'll go ahead and get started because we've got a good deal to cover today. Let's see. Okay, so today we're going to talk about savvy Social Security planning. In the short presentation, we'll be focusing on basic rules and strategies so you can find out what you need to know and know more, because there are a whole bunch of Social Security laws and not everything is important to everybody, but we'll try to talk about the main points today. And because Social Security planning is such an individualized manner, you may have questions about your personal situation. And your advisor or someone at our firm will be glad to meet with you another time and discuss the rules and strategies that pertain to you. So like Betsy said, please hold your questions, enter them in the chat box at the bottom, and then we'll try to get them at the end. All right, let's get started. The first and most important thing to understand is that monthly benefits rise with claiming age. In other words, the longer you wait to file for Social Security, the higher your benefit will be. To illustrate this, we need to cover a little background first. We'll start with some definitions. Your primary insurance amount, or PIA, is your base monthly benefit. It is calculated at age 62, and it's based on your highest 35 years of earnings. It's the amount you receive if you file for Social Security at your full retirement age, which I'll talk about next. During this presentation, we'll not be talking about how the PIA is calculated, but it's important to know that it's based on your earnings history. If you earned the Social Security maximum every year for 35 years, you would qualify for the maximum PIA, which is $3,357 for those turning 62 in 2022. So what I mean by that is just how much of your income each year is subject to Social Security tax. And that has been adjusted for inflation over the years, but if you earned that maximum, you would be getting the $3,357 a month. And if you worked less than 35 years, or if you had several low earning years, you may still have an opportunity to increase your Social Security benefit by working longer and earning more. For retirement age, this is not necessarily the age you plan to retire. Rather, it's just the age at which you can claim your full unreduced Social Security benefits. This used to be 65 for everyone. Now a higher age is being phased in as a result of the 1983 amendments. For everyone born between 1943 and 54, full retirement age is 66. And for everyone born in 1960 and later, full retirement age is 67. And if you're like my parents and you're born in between 1955 and 59, it's 66 plus some number of months. So if you think of Social Security, which Social Security insurance, it is social insurance to guard against the loss of income when you retire and quit working. If you think about the Social Security withholdings that have been taken out of your check for all of these years as a insurance premium, then your full retirement age is the age at which you may apply for that full unreduced benefit. So you've been paying an insurance premium, and to get the full amount that you've are due is if you get that if you claim at your full retirement age, or FRA. Claiming Social Security before your full retirement age will cause your benefit to be reduced. Your benefit will be less than your primary insurance amount. This is called the actuarial reduction. And conversely, claiming Social Security after full retirement age will cause your benefit to be higher than your PIA because you will be getting delayed retirement credits. The important thing to understand about reductions and credits is that they have been carefully worked out by Social Security actuaries so that the effect upon the system is the same. Whether people file at 62 or 70 or any age in between, Social Security is dealing with a whole population of people, and they know that some will die early and some will live a long time. On balance, it doesn't matter to them whether people file and how much of a reduction or credit they get, but it's very important to one individual because the age you file determines your permanent monthly benefit. If you live longer than average, or if there's even a chance you might live longer than average, you'll be better off filing later and collecting a higher benefit for life, even if it means waiting a few more years for your checks to start. So the important thing to remember here is not when you get your first check that's important. The most important part is the size of that first check. Because remember, monthly benefits rise with claiming age. All right, now remember that I said your PIA is the benefit you receive at full retirement age. So what happens if you apply for Social Security before your full retirement age? Well, you can see here on this chart that your benefit will be reduced. You'll receive a percentage of your PIA depending on when you apply. If your full retirement age is 66 and you apply at age 62, you'll only receive 75% of your PIA, and at 63, 80%, and so on. And if your full retirement age is 67 and you apply at 62, you'll receive 70% of your PIA. These amounts are actually prorated monthly, so you can apply anytime after the age of 62 and your benefit will be reduced by the appropriate amount. So you don't have to, these years aren't breakpoints. Like I just mentioned, each month that you wait to claim, your benefit gets a little bit higher. This is just an easier way to understand it on the yearly basis. So consequences of filing after your full retirement age. Don't understand why they're calling it consequences. It's a benefit of filing after full retirement age, but you'll earn delayed credits of 8% for each year after you delay. So if your full retirement age is 66, you could actually get up to 132% of your PIA. And then if your full retirement age is 67, since you have one less year to earn that 8%, you can only get 124%. After age 70, you can't earn any more delayed credits, so it doesn't pay to wait after age 70 to apply for Social Security. I don't think they make you apply, but you're not getting any benefits, so you might as well go ahead and apply at 70. Now, I mentioned the age at which you claim Social Security determines your permanent monthly benefit. However, in any year there's inflation, your benefit will get a cost of living adjustment. So I know it's a hot topic right now. The 2022 cost of living adjustment was 5.9%, but historical COLAs have varied widely, and the Social Security Administration's projected COLA over their 75-year time horizon is 2.4% annually. So, you know, I know we're all feeling the pain at the grocery store and other parts of our lives right now with inflation. So I've seen estimates for the 2023 COLA to be anywhere from 6% to 10%. And they typically announce those towards the end of the year, and then they would be effective in January. Now, the COLA is applied to your benefit amount. The higher the benefit, the higher the COLA will be, and it applies to benefits you haven't claimed yet. So even though you haven't claimed Social Security, you are getting these cost of living adjustments. So once your PIA is calculated at age 62, it will rise each year with the cost of living adjustment, even if you delay claiming to age 70. So the upshot is that between delayed credits and cost of living adjustments, the advantage to delayed claiming is greater than most people realize, because you've got your benefit, and then you get a 5.9% cost of living adjustment on top of that benefit. And then if you're waiting to claim, then your 8% or 16% or 24% delayed retirement credit is compounding on top of the COLA that's already compounded. So it ends up being a much better deal for you. So some key points to remember. The when to apply question is very complex and requires a customized analysis, but there are a few points to remember. If you apply early, your benefit starts out at some fraction of your PIA, 75% or 80% or whatever, and remains at that percentage for the rest of your life. It does not go up to 100% when you reach your full retirement age. So I'm going to repeat that. If you claim early, your benefit starts lower and stays lower for life, aside from COLAs. And COLAs magnify the impact of early or delayed claiming because the annual cost of living adjustment is applied to either the lower or the higher amount. This causes the disparity to increase with each passing year. And the when to apply question impacts survivor benefits as well. If the higher earning spouse maximizes his benefit by delaying to age 70, this higher benefit will transfer over to the lower earning spouse at death. But I'll cover survivor benefits here in a minute. And of course, you'll need to take into account your health status, life expectancy, income needs, and overall retirement plans when deciding when to claim Social Security benefits. So like most things in life, there's not a one size fits all. This decision is gonna be different for everybody. If you don't have a long life expectancy and maybe have some health problems, maybe you need to claim early. Or if there's a age disparity that could between you and your spouse, that could affect things as well. So there are 3 ways to estimate your Social Security benefit. One, you can obtain your Social Security statement at socialsecurity.gov. You'll need to set up an account. You can also use the retirement estimator on the Social Security website. This calculator taps into your specific earnings history after you enter your personal identifying information, including your birth date, Social Security number, and mother's maiden name. Don't worry, the site is secure. And please note that the annual statement and the retirement estimator do not factor COLAs into your age 70 benefit. This means your actual benefit will likely be higher than they indicate, but our calculators do adjust for COLAs. So if you know your PIA, we can help you project your future benefits with those cost of living adjustments in there. Now, obviously, we don't know what the future COLAs will be, but we can make an educated guess. So you also might want to try one of the 3 calculators on the Social Security website at ssa.gov/planner/benefit calculators. Feel free to browse around the site and play with the calculators. So to access these, you need to create a ssa.gov online profile. So it's important to go ahead and do that for several reasons. One, you can access your current Social Security statement and view your estimated monthly benefit. I've got a little ways off till I'll be eligible for Social Security, but I can still go ahead and I looked at my statement the other day. And the second thing is you need to double check your earnings history for errors. This one's important, especially if you have ever been self-employed, because the way self-employed people pay Social Security taxes as the employer and the employee is a self-employment tax, and it gets reported just a little bit differently. So you want to make sure that your earnings history is represented correctly on your Social Security statement. The third reason, and this is an important one, helps to prevent hackers from doing you a favor and creating an account for you. So a common scam that's we're starting to see more involves a malicious actor, all of our personal identifying information from all of the various leaks and hacks from different websites over the years. There's a lot of information out there about us, and if a malicious actor gets their hands on some of that, what they can do is they go and create an account for you, and then they apply for Social Security for you, and they get the check sent to them. And you're none the wiser because you don't find out about it until you go to file your taxes for the next year, and the IRS says, hey, why didn't you claim this $26,000 in Social Security benefits that I know you got? And then that will take a while to straighten out. So go ahead, make an account for yourself, and it prevents someone from doing that for you. It's also very important to write down your password for this, because unlike resetting a password for your Netflix account or your email account, this one is a little bit more involved. And lastly, like I said, you can apply for your Social Security benefit online. Okay, now for basic rule number 2, your spouse may be able to get a benefit based on your earnings record. Before we discuss the spousal rules, I'd like to make a few quick clarifications. Back in 1939, spousal benefits were originally created to give non-working wives a small benefit based on their husband's work record. But Social Security is a gender-neutral program. Husbands may be able to claim spousal benefits too. And now that same-sex marriage is legal in all states, either spouse, regardless of gender, may be able to claim a spousal benefit. More important in this age of 2-income families is that spousal benefits may be paid even if both spouses work. Here are the rules for spousal benefits. The spousal benefit equals 50% of the worker's PIA if the spouse applies for it at full retirement age. The primary worker must have filed for benefits. That's just a rule. So in order for Jill to claim a spousal benefit based on Jack's work record, Jack must have filed for his own Social Security benefit. This rule comes into play when we talk about claiming strategies, and it can trip you up if you're not careful. A spouse must be at least age 62 to file for a spousal benefit. That's another rule. If the spouse claims the spousal benefit at 62, the benefit will be reduced, as we'll see in a moment. And spousal benefits do not earn delayed credits after age 66. The most a spouse can ever get is 50% of the other spouse's PIA. So in this scenario, if Jack is the higher earner, and Jill is 4 years younger than him, even though Jack waited till 70 to claim his Social Security, and Jill claimed her spousal benefit at her full retirement age, she'll not get the 132% that Jack will get of his PIA. She'll only get his PIA at his full retirement age, because it maxes out at 50% of that number. And finally, for the most part, you can only get a spousal benefit if it is greater than the benefit available on your own record. That is, if 50% of your spouse's PIA is higher than your own PIA. There's an exception here, but it's complicated, so we're going to circle back to that in a moment. But first, let's talk about how these benefits are calculated. So the takeaway here is you can't get your benefit and 50% of your spouse's benefit. Is just, if your benefit is lower, the maximum you can get is 50%. So the spousal benefit is 50% of the worker's PIA if she applies for it at her full retirement age. So if Jack's PIA is $2,000 in this example, and Jill's is $800, and if Jill applies for Social Security at her full retirement age, her benefit will equal 50% of Jack's PIA, or $1,000, which is $200 more than her benefit based on her own record. So she'll just get the $1,000 benefit, which is 50% of Jack's. But what if the lower earning spouse's PIA is more than half of the other spouse's PIA? In that case, she may not receive a spousal benefit at all. Instead, she would be paid her own benefit. So this example, Jack's PIA is still $2,000 a month, but Jill's is $1,500 instead of $800. And because Jill's PIA exceeds the 50% threshold of Jack's, she will be paid her own benefit, not the spousal benefit. But there is an exception to this, but it doesn't apply to all people. The exception: if Jack, in our example, was born in 1953 or earlier, he may file a restricted application for his spousal benefit and receive 50% of Jill's PIA while his own benefit builds delayed credits to age 70. This strategy can give couples tens of thousands of dollars in extra spousal benefits and was considered a loophole which was closed by the Budget Act of 2015, but the new rules being phased in. People who were 62 or older at the end of 2015 are grandfathered under the old rules. So if you're eligible for it, we'll definitely encourage you to do it. I'll show you an example. So remember, they first start calculating your PIA at age 62, because that's when you're first eligible to claim Social Security. And so to be grandfathered in, you had to be eligible to claim by being age 62 at the end of 2015. So that's how you're grandfathered into this. Spousal planning maximization strategies. Regardless of which rules you fall under, the key to maximizing benefits for a married couple is to coordinate the two benefits. Here's what we found. When both spouses have relatively high PIAs, that is, the lower earning spouse's PIA is more than half of the higher earning spouse's PIA, it pays for both spouses to claim their respective benefits at age 70 to get the maximum delayed credits. Our calculators show that if both spouses have average or longer than life expectancies, this will maximize benefits for both of them over their lifetimes. So that's under the new rules. Or it may be possible for one spouse to receive a spousal benefit while his or her own benefit bills delayed credits. This is the exception I mentioned earlier. If you're over 62 at the end of 2015, you may be able to claim a spousal benefit at age 66 and receive 50% of your spouse's PIA, while your benefit bills delayed credits to age 70. If you have questions about this, come talk to us and we can help you figure out what's going to be best for you. But that's the old rules that you could be grandfathered into, but maximizes lifetime benefits over average or long life expectancies. So here's a spousal planning maximization strategy example. Bob and Betty are married. They are both age 60 now. Bob's PIA is $3,000 a month and Betty's is $1,800. Let's assume life expectancies of 85 for Bob and 95 for Betty. When do you think they should claim their Social Security? So I'm going to show you what our calculator says. So this has 4 scenarios. In scenario 1, they both claim as soon as possible at age 62. In scenario 2, they claim each at full retirement age, which is 67 for both of them. So you can see the reduced benefit. Bob's, if he claims on his own record at his full retirement age of 67, his benefit would be $3,446 a month. Whereas if he claimed early at 62, he would get about $1,200 less per month. In scenario 3, Betty claims early at 62, but Bob claims later at age 70. And then scenario 4 is the maximum benefit based on life expectancies of 85 for Bob and 95 for Betty. This scenario calls for each of them to claim at age 70. So instead of his full retirement age benefit of $3,446 a month, Bob gets $4,535. So scenario 4 is the best one for them. So here the graph the bar chart shows the lifetime benefits for each claiming scenario. So again, what we're trying to do here is maximize your cumulative lifetime benefits. And obviously some of that, or a lot of that hinges on how long you live. So we like to plan for you to live for a long time, but you can see here that in scenario 4, the maximum lifetime benefits is 2.3 million, so $2,360,987. And then strategy 3 of Betty claiming early and Bob claiming later gets you $2,247,938. And then scenario 1, where they both claim early, only gets you 1.7 million. So there's about over $600,000 difference between claiming early and both waiting to claim late. And one question we get a lot is about the break-even point, and that is just when one strategy, your maximum strategy, breaks and crosses over another strategy. So for most people, if you live to somewhere between age 78 and 82, that's where the break-even point falls for most individuals and couples. That just means that if you live longer than your break-even point, so say, let's call it age 80, then if you live longer than age 80, then you will have been better off waiting to claim. So you can see here that the scenario 1, where they both claim early in the green, on the line chart at the bottom, it starts much earlier. It starts in the year 2024, but it's got less of a grade. It's got less of an angle on it. Whereas when they claim at full retirement age in the blue, starts later, but it's a little bit steeper line. And then the purple strategy 4 is the maximum, starts the latest, but it has the steepest line. And then as time goes on, the difference, the distance between those cumulative lifetime benefits grows. So the break-even point here is somewhere in 2043, it looks like. But either of the strategy 3 or strategy 4 would have maximized Betty's survivor benefit. So we'll talk about survivor benefits here in a minute. Okay, here's another basic rule. A divorced person may be able to get spousal benefits based on their ex-spouse's work record. The rules for divorcees are similar to the ones for married couples, but there are a few additional restrictions. So the rules for divorce spouse benefits are the same as spousal benefits if the marriage lasted 10 years or more. The divorced person claiming the benefit is currently unmarried. These are the 2 key rules. It doesn't matter when the marriage and divorce took place. If the marriage lasted at least 10 years, even if the divorce occurred a long time ago, a divorced person may be able to claim Social Security based on that ex-spouse's work record. The person claiming the benefit must be currently unmarried. You could have had 2 or 3 marriages after that first one, but as long as those other marriages ended and you are currently unmarried, you can claim a divorce spouse benefit. If you have more than one ex-spouse in your past, if the marriages each lasted 10 years or more, you can choose which spouse's record to claim benefits on. The order of the marriages and divorces doesn't matter. So what is it they say? You marry the first time for love and the second time for money. And then, you could get married a third time if you're Donald Trump, but doesn't matter. You just, whichever of those ex-spouses had the highest Social Security amounts, you can get theirs, provided you meet the other rules. So if you're the ex-spouse, they must be at least age 62, and if the divorce occurred more than 2 years ago, the ex-spouse doesn't need to have filed for his or her benefit. There are a few more things to know about divorce spouse benefits. First, more than one ex-spouse can receive benefits on the same worker's record. So, I think Donald Trump's been married 3 times. I'm just going to assume he was the higher earner in all 3 of those marriages. So all of his ex-wives can claim on his record. So if your ex-spouse has remarried a couple times, all 3 exes can claim divorce spouse benefits as long as the marriage has lasted at least 10 years. Johnny Carson's another example. He was married 4 times. His first marriage to Jody lasted 14 years. His second marriage to Joanne lasted 9 years. His third marriage to Joanna lasted 13 years. And his fourth marriage to Alexis lasted 18 years. So Jody and Joanna could have each claimed divorce spouse benefits on his record because those marriages lasted more than 10 years. When he died in 2005, both Jody and Joanna could claim divorce spouse survivor benefits, and Alexis could claim a regular survivor benefit because she was still married to him when he died. But his second wife, Joanne, was out of luck because that marriage only lasted 9 years. This is another question we get a lot. The benefits paid to one ex-spouse do not affect those paid to the worker, the current spouse, or the other ex-spouses. So if your ex is going to claim Social Security on your earnings record, doesn't have any effect on you. You won't even get a notification that it's happening, won't affect your current spouse or your benefit. Another thing is you don't need to know your ex-spouse's whereabouts, only enough identifying information that the Social Security Administration people can look up his or her records. So like a birth date, Social Security number would obviously be very helpful. But full legal name, stuff like that. You'll also need to provide documentation showing the dates of the marriage and divorce. If you're receiving divorce spouse benefits and you remarry, the divorce spouse benefits will stop. However, you may be then eligible for spousal benefits based on your new spouse's work record, or you can switch to your own benefit, of course, if you also qualify for Social Security. All right, covers divorce. We've mentioned this several times already today. This is where things start to get a little less basic. Survivor benefits. We'll try not to get too lost in the weeds today, but survivor planning is essential, and there are a few things you should absolutely know. First, let's discuss who can get a survivor benefit. In order to be eligible for a surviving spouse to receive survivor benefits, the marriage must have lasted at least 9 months, except in the case of an accident. To start benefits, the survivor must be at least 60 years old or 50 if disabled. However, if the widow or widower applies before full retirement age, the benefit will be reduced as it is for regular retirement benefits. Some of the same principles that go into deciding when to apply for regular retirement benefits also apply to survivor benefits. So this is where things are a little bit different. So you recall that for a spousal benefit or divorced spouse benefit, or even your own Social Security benefit, you're not eligible to claim until age 62. But for a survivor's benefit, they give you a couple extra years, so you can be eligible and you can actually claim for that at age 60. If you remarry before age 60, you will not be able to receive a survivor benefit based on your previous spouse's earnings record unless your remarriage ends. We've seen cases where a survivor is contemplating remarriage in their late 50s. So if you're 59 and think about getting married, we recommend a long engagement in order not to lose those survivor benefits from the first spouse. If you remarry after age 60, you will still be able to get those survivor benefits. And lastly, divorced spouse survivor benefits are available if the marriage lasted at least 10 years. As we saw with Johnny Carson, 2 of his ex-wives could claim divorced spouse survivor benefits after his death because those marriages lasted more than 10 years. Survivor benefits are worth twice as much as spousal benefits because you can get 100% of the worker's PIA instead of 50%. If both spouses are receiving benefits and one spouse dies, the other spouse may switch to the higher benefit. So let's look at this example. Let's say Joe and Julie are married, both are over full retirement age and currently receiving Social Security benefits. Joe's benefit is $2,000 a month and Julie's is $1,200. If Joe dies, Julie's $1,200 benefit will stop and she will start receiving $2,000. One important note about survivor planning is the loss of one benefit. Most widows and widowers need at least 2/3 of the amount of income they were receiving as a couple. So it is important to plan for the loss of one spouse's Social Security benefit, even though it is often the higher benefit that will be retained. The death of a spouse means the loss of one Social Security check. So with this, they were getting $3,200 a month. Julie will, when Joe passes away, Julie will notify Social Security and she'll no longer receive her $1,200 a month. Hers will get increased to $2,000, which was Joe's benefit, but again, they're losing Julie's $1,200 benefit. And lastly, please note that if Joe had maximized his benefit by filing at age 70, you could say his benefit was $2,600. With the addition of delayed credits, Julie's survivor benefit would be $2,600 instead of $2,000. So this is, again, another difference between survivor's benefits and spousal benefits. The spousal benefit, the maximum you can receive is 50% of the higher earners' primary insurance amount. So 50% of what they would get at their full retirement age, provided you claim at your full retirement age. But with survivor's benefits, you can get those delayed credits that the higher earning spouse attains. So whatever the higher earner spouse's Social Security benefit is at the time of their death, you can get that. So potentially, it could be 132% of their full retirement age benefit. So without going into too much detail here, the main point I want to get across is that the amount of the survivor benefit will depend on two things: the age at which the deceased spouse originally claimed his or her benefit. This determines the original benefit, and the age at which the widow or widower claims the survivor benefit to determine the actual benefit. The widow or widower will receive the highest income if the deceased spouse originally claimed his or her benefit at 70 and the survivor claims the survivor benefit at full retirement age or later. So again, two things. If the higher earner that passed away first, if they maximize their benefit by waiting until 70, part of that is done. But again, the age at which you claim Social Security matters. So to get 100% of whatever the deceased spouse's benefit was, you have to also be, you have to claim at your full retirement age or later. So if you claim at 60 when you're first eligible, you'll get a reduced amount of that benefit. Higher earning spouses who feel young and healthy often don't think about the survivor benefit when they are deciding to claim their own benefit. But as we saw with the examples of Bob and Betty, the survivor's income can be significantly lower if the higher earning spouse claims his benefit early. Survivor planning is a very important part of savvy Social Security planning for married couples. It can really influence their surviving spouse's standard of living later in life based on decisions you make now. It's really a customized process, so please speak to your advisor if you need some help with this. Strategies for widows and widowers. What if you've already been widowed? Let's say your spouse died either before or after starting Social Security benefits, or maybe you were married over 10 years, divorced, and your ex-spouse has died. Is there anything you can do to coordinate your survivor benefit with your own retirement benefit to maximize income and lifetime benefits? The answer is yes. You can sequence your benefits to maximum advantage. You can start with one benefit and then switch to the other one. The rule here is to always take the higher benefit last. If the survivor benefit is higher, start your retirement benefit at age 62 and switch to your survivor benefit at your full retirement age. But if your retirement benefit is higher, start your survivor benefit as early at age 60, so you get 2 extra years, and switch to your retirement benefit at 70. So in this second bullet point here, you get 2 extra years because you're claiming the survivor benefit first, and then you're letting your own benefit, which is higher, get even higher by getting those delayed retirement credits. And you can get the survivor benefit for 10 years, and then the your own benefit, you'll switch to it at age 70. So here's an example of sequencing. Wanda is widowed. She's 60 years old now and has a PIA of $1,200 a month. Her husband died before claiming Social Security. His PIA was $2,600. Now, there are 2 things Wanda can do. One, she can resist the temptation to start her reduced survivor benefit at 60 and hold out for the maximum by applying for it at full retirement age. When she turns 62, she can start her own reduced retirement benefit and then switch to the survivor benefit when she turns 66. Or she can go ahead and start her survivor benefit now at age 60. This might be the natural choice since the survivor benefit is higher and she wants to start income right away. But she may not realize that by claiming the survivor benefit now, it will be permanently reduced for life. So she would get $1,859 versus $2,600. So which claiming scenario do you think will give her more cumulative lifetime benefits? As we can see, Wanda receives more lifetime benefits if she waits 2 years and claims her own benefit at 62 and switches to her maximum survivor benefit at full retirement age. These claiming scenarios are not always intuitive. That's why we depend on calculators to show us what benefits would be over a lifetime based on the different claiming ages. Notice that the calculator ran through 41,000 scenarios in 7 seconds. So I know sometimes I'm guilty of this, that we think we're smarter than the computers. We think we're smarter than the GPS, but I would say more often than not, I am proved wrong, which my wife will tell you I don't like to admit. But again, the key to remember, you always take the higher benefit last. So in the scenario for Wanda, the survivor's benefit was higher, so she started hers early and then switched to it at her full retirement age. Basic rule number 5. If you claim benefits before full retirement age and work, your benefits will be withheld. We call this the earnings test. So we've already discussed the disadvantages of early claiming in terms of the actuarial reduced Social Security benefit, but the other problem is that claiming early might be a moot point. If you claim before your full retirement age and continue to work, your benefits will be withheld. The annual earnings test. If you apply before your turn full retirement age and you earn more than $19,560 in 2022, $1 in benefits will be withheld for every $2 you earn over this limit. Now, it's important to know that this money isn't truly taken away. Rather, your benefit will be adjusted upward when you reach your full retirement age to make it as if you had applied later. This means that if some of your benefits are withheld due to the earnings test, your new benefit will be higher as if you had started at 63 or 64 or 65 instead of actually claiming at 62. This can actually be advantageous in the event that you filed at 62 and regretted it. You also get one do-over. So if you file, I think within 12 months, you can tell them you changed your mind and you pay back all the Social Security you've received, plus a little bit of interest, and then it's like you never even claimed. They give you one do-over. Please don't let the annual earnings test discourage you from working. The more money you earn, the more money you will have. Social Security does not penalize you for working. Once the adjustment is made, you will end up with a higher benefit for the rest of your life. And of course, the earnings themselves will contribute to your financial well-being. To avoid the earnings test entirely, just wait until your full retirement age or later to apply for benefits. So again, this is kind of in the same vein as marginal taxes. Like, yes, as you make more income, you pay more on a marginal rate in taxes, but it's never going to get to a point where you earn more and go away with less money. You're still getting more money, just a little bit more of it's going away with taxes. Same idea here in that it's not a penalty because you'll get this adjustment for going over the earnings test. They adjust your Social Security benefit at your full retirement age. So even though they are withholding your benefit in real time, you're working, so you're getting that income, and then you'll get the adjusted increased benefit when you reach your full retirement age. So it's, again, not a bad problem to have. So there's some different rules for the annual earnings test in the year that you reach your full retirement age. So if you apply for Social Security before your full retirement age, but you continue working, this applies to the calendar year that you reach your full retirement age. $1 in benefits will be withheld for every $3 you earn. So that's one change. It's $1 for $3 instead of 1 for 2. And then the limit increases too. So instead of $19,560, it is $51,960 in 2022. But that number is annualized. So if you divide the $51,960 by 12 months, it equals $4,330 a month. So let's say that your birthday is in January or in October. So it's towards the end of the year, it's last quarter of the year. And you have a job that pays you very well, and you made $100,000 in the first half of the year, but you want to retire on July 1st. You want to retire at the midpoint in the year, but you've passed the annual number of 51,960 for the earnings test, and your full retirement age is not until your birthday in October. So they give, the way they do the calculation, they give you the number that's most beneficial for you. So even though you exceeded the earnings test in the first 6 months of the year with the 100,000 of income, presuming that you're retired in July in August and September, you can still claim Social Security, and it's not going to be withheld, because if you don't earn more than $4,330 in each of those months before your full retirement age, it doesn't count against the earnings test. So they do work around that. They understand that people's birthdays are in different times in the year, so they'll reach full retirement age in different times of the year, and people want to retire when they want to retire. The other thing I should note is that the old way of thinking is that when you retire, you go ahead and claim your Social Security, but I think these two decisions are independent of each other, and I'll discuss those in a little bit. Some little known rules about the earnings test. It applies to all benefits received before full retirement age, retirement, spousal, and survivor. It may even cause your spouse's benefits to be withheld. If John and Jane are 62 and Jane is getting a spousal benefit off John's record, and John goes back to work, then Jane's spousal benefit will be withheld, because the earnings record that they're basing this on is getting, he's going back to work. So it'll apply to any benefit that is calculated off of that earnings record. And if you're self-employed, you may be subject to extra scrutiny, because this is the scenario where the business owner gets to dictate how much salary he gets, and so they would pay themselves a small salary to get around the earnings test. And so they understand that people do that, and so you'd probably be subject to extra scrutiny from the government. All right, the last basic rule. Your benefits may be subject to tax. What is it they say? The only guaranteed things in life are death and taxes. Well, yes, you'll have to pay taxes on your Social Security, but how much depends on your income. So the way they calculate this, you see at the bottom, provisional income, that is your adjusted gross income, which is your income before deductions and over the line deductions and like the standard deduction. So it's your adjusted gross income plus 1/2 of your Social Security benefit plus any tax exempt interest. So if you're married filing jointly and your provisional income is under $32,000 annually, you don't have to pay taxes on your Social Security. If it's over $44,000 annually, up to 85% of your Social Security will be taxed, and then it phases out between $32,000 and $44,000. You can minimize taxes on Social Security by lowering your other income, especially investment income, but you should be aware that municipal bond interest, which is usually tax-free, counts as income for the purpose of calculating the tax on Social Security benefits. Here are some other things you can do. Anticipate the required minimum distributions from your IRA, which may cause you to be in a higher tax bracket, may cause some of your Social Security benefits to be taxable. So you can consider drawing down IRAs before age 72 to reduce those RMDs. You could consider converting to traditional IRA to Roth IRA, which generates tax-free income. So I'm sure your advisor has mentioned looking at this, since we're in these, the Tax Cuts and Jobs Act of 2017 gave us these low marginal tax rates that we're in now. So it's a good idea to look at that. There's several strategies around Roth conversions that we can help you explore. You can also delay Social Security in order to reduce the number of years that benefits are subject to tax. So again, even if you're over your full retirement age, where you're not, and you're still working, but you're not subject to the earnings test, your income will likely put you over so that your Social Security is at its max taxation, and you can reduce your expenses, pay down debt, and adopt a simpler lifestyle so you can make do with less income, and continue to manage taxes throughout retirement, not just the first years. As always, please consult with your own tax advisor about your individual situation. So you have questions, we can help. We've covered a lot of ground today, but you probably still have some questions. When should you apply for Social Security? What if you want to keep working? What if you've already applied? How much will your benefits be? Can you coordinate spousal benefits? What's the best long-term strategy for your situation? And what should you do next? We'll be glad to help you consider each of these questions individually and help you come up with a plan for your personal situation. because Social Security is too important for guesswork. Let us help you protect your nest egg and maximize your income in retirement. So like I said a minute ago, the old way of thinking is that you retire and then you take your Social Security. But the new way of thinking is to look at all of our different assets, because we don't have pensions and that guaranteed income that a lot of our parents did. So the most flexible time in your life from an income and tax standpoint is from the day you retire until you reach age 72, which is when you have to take required minimum distributions, or RMDs, from your pre-tax accounts like your IRAs. So that's when the government starts forcing you to take money out. But in that time, you can control how much income you get, how much you're pulling out of your IRAs. You can control when you claim Social Security. If you take it at 66, or you take it at 67, or 67 in 1 month. You have flexibility around all of that. And so it gives you a great opportunity to really maximize your chances of success in the long run. Because remember what I said, even if your plan says that your best strategy is to claim at 70, some things might change. And as we talked about, each month that you delay claiming, your Social Security benefit gets a little higher. So let's say that your circumstances do change and we need to claim at 68 in 4 months. Well, guess what? You're better off than if you had claimed at your full retirement age of 67, or if you'd claimed at 62. So there are lots of ways to integrate this, because Social Security is such an important piece of the retirement puzzle for so many Americans. It's especially important to incorporate your Social Security strategy into your overall financial plan. And with so many different claiming strategies, it's important to analyze the different Social Security scenarios, both by themselves and as part of your overall financial plan that incorporates your goals and other resources. So longevity, this is just looking at your someone's cumulative lifetime benefit if they have a shorter life expectancy at 75, expected life expectancy of 85, or a long life expectancy of 95. You can see how big the difference is there with longevity. And this is, again, we're trying to maximize your cumulative lifetime benefits. So in a vacuum, make sure to look at how longevity will affect your cumulative lifetime benefit, and then compare scenarios that use different claiming ages. So the green bars are if you claim with your primary strategy, which I believe for this example is if both spouses wait until age 70, or you can claim early at age 62. And you can see that even with a normal life expectancy, they're about $300,000 better off waiting. And then with a long life expectancy, that the magnitude of that difference gets much wider. And one thing to note, I know I've mentioned that it's different for everybody. One thing that really affects when the lower earning spouse should claim Social Security is ages. If there's a big age gap, it might make sense for the lower earning spouse, if they're also younger, to go ahead and claim Social Security early. So that's one thing that I want to be sure to point out. We've already discussed a break-even analysis. So after you compare strategies, you can find a break-even point, which is the point at which one scenario's cumulative benefit becomes greater than another's. Oftentimes, this is comparing a wait until 70 strategy to a claim early at 62 or full retirement age strategy. In this example, the wait until 70 strategy becomes better than claiming early as long as you live to at least age 79. You can see there as they cross over. But since no one has a crystal ball, it's difficult to predict when we'll meet our demise. You also have to incorporate your Social Security strategy into a comprehensive financial plan that incorporates your goals and other resources. So I'm sure lots of you have seen this software. This is a financial goal plan. It uses the spending goals that you anticipate. And then from there, we can use a planning tool that employs a Monte Carlo simulation to help with your decision making. So you can see here, this is using all of our investment resources and our IRAs and our taxable accounts and our Roth IRAs and our Social Security and any pensions and any part-time work or post-retirement income. And then we take all those resources, and then we calculate the taxes and what it's going to cost to fund all of those goals that we saw on the previous screen, all of these spending goals. And it simulates that 1,000 times, and it gives us a probability of success, which is a really good decision-making tool, because then we can compare Social Security claiming strategies. So this one is just straight comparing claiming early, claiming at your full retirement age, and claiming it's your primary strategy, which is maximization at age 70. And you can see there's a big difference, a 13% probability of success difference between claiming at 62 and claiming at full retirement age. And then a marginally smaller difference, but still it adds to the probability of success, and it gets us in this confidence zone by claiming at age 70, so a 3% difference there. But like I've said, financial planning is a dynamic process, so if something in your life changes, it could alter these as well. And then obviously we can look at a multitude of other factors other than just how Social Security affects your overall financial goal plan success. But we want to work with other assets so we can help model an income plan that minimizes lifetime wealth lost to taxes and helps ensure that you are making the most of your resources. Because again, I'm sure most of y'all, like me, don't love paying taxes. And so, even though we do something to reduce our tax bill in one year, it could ultimately increase our tax bill in future years. And so we want to develop an income plan that maximizes or minimizes your total lifetime wealth that we lose to taxes. So whether you can work with other strategies. So whether you're analyzing the pros and cons of your different Social Security scenarios or trying to see how Social Security fits into the rest of your plan, there are plenty of resources available to make sure that you can make a well-informed decision, because Social Security is too important for guesswork. So in this scenario, like I mentioned, because we've got these low tax rates that, barring any preemptive legislation, are due to sunset at the end of 2025. They were always designed to be temporary. So on January 1, 2026, we will revert back to the higher tax rates. But here you can see the yellow is we're looking at Roth conversions, and the bar chart over here is estimating the total lifetime tax savings of those Roth conversions of $428,000. So you can see that we doing some Roth conversions, and then we take some Social Security income, and then we get to the year where it just doesn't make sense to do any more Roth conversions. But there's lots of strategies, but like I said, there's lots of tools available to look at Social Security by itself in a vacuum, but then we want to expand that and incorporate the Social Security decision into the rest of our overall financial plan.
Thank you so much, David. Oh.
I was just going to say it's what everybody's waiting for. I'm back on big on the screen again.
Well, thank you. That was fantastic information. We only have one question right now, and if anyone else has anything else, please drop it in the chat box. But someone would like to know, if you aren't comfortable or you don't have access to the internet, can you go in person to the Social Security office? Do you need an appointment? How does that process work?
I don't know the answer to that, but I will say that if you live in Athens or around one of the surrounding counties where our office is based, we are fortunate that you could come see us, and then you could drive about 2 minutes down Prince Avenue, and we have a Social Security Administration office right here in Athens. I know during the pandemic they were by appointment only. I imagine that has since changed. It would not hurt to give them a call if they have a local number to find out. But that way you could at least get the updated copy of your Social Security statement, because they used to send those. They used to send those about every 6 years, and then the closer you got to being able to claim Social Security. They started sending them more often. I am not sure what their schedule is now, because sometimes people come in and they have a 4 or 5 year old Social Security statement, and sometimes they come in and they just happen to receive one recently. But I believe that probably you would be able to go and they would be able to help you out there.
Very good.
One thing to note about getting help from the Social Security Administration, they can tell you things about your benefit, like if you claim now, it will be this. If you claim at this age, it will be this amount, and so on. I don't think that their purpose is to give you facts. Their purpose isn't to help you find out which strategy is going to be best for you.
Right.
So they're just more informational.
Perfect. Well, if anyone has additional questions, you can email them to us. You can send them to marketing@elevate-wealth.com, and I'll make sure that David gets those questions and gets back to you. And then I'm going to share my screen really quick. I wanted to show you all. This is our new YouTube channel. And so if you go onto YouTube and you look for Elevate Wealth Advisory in Athens, you'll see our team here. And then our WealthWise video list here is full of information. And David has been giving some shorter videos about Social Security this month. So the best way to do that is just go to YouTube and search for us, or you can go to our website, which is here, elevate-wealth.com, and then just scroll down to the very bottom and you'll see a link right here to Facebook, Instagram, LinkedIn, and YouTube, and you can just go on and find us there and subscribe. If you hit the subscribe button, you will make sure that you won't miss any episodes when they come out. So thank you very much, David. We really appreciate your time today, and we'll look forward to seeing you all in the office soon. Take care. Bye.